Money market funds, as you have seen before, have come out as safe, good parking points for our unearned money as we look for opportunities to put that or invest the money. They are safe holding points for our money. The following are 10 practical, valid, good reasons why a money market funds is a good avenue for our emergency response and emergency fund creation. Number one, flexibility. Emergencies are not anticipated. They just happen. They are accidental. And their response in many times should be quick and precise. For that reason, and on flexibility of a money market fund, this platform allows us to withdraw money out of the investment without attracting any penalty or losing the interest or returns that we have already built up. Response to emergencies at some times may leave us constrained. Flexibility of money market funds give us minimum requirements for top-ups and future investments, in that we can reduce our periodic or regular monthly top-ups to as low as 100 shillings. Number two, accessibility. Again, emergencies, when they strike, they require a quick response, which means our solution avenues or our source should give us the least turnaround time from the point of request for the withdrawal. Money market funds have shown to give us turnaround times of hours, in some cases or small amount, and for substantial amounts we have a minimum of a day, others on average is 3 days. That is a good turnaround time to respond to emergencies. On top of that accessibility, money market funds are offered on online platforms that require minimum human intervention once requests are placed, and for that reason, that enhances quick delivery of amounts requested and thus response to our emergencies. Number three is protection. Emergency funds, even when we draw down and access our withdrawals, they do offer a wide range in terms of protecting our money, because you cannot tell when an emergency will strike. So therefore, the platform offers a safe, low-risk opportunity where we can safely keep our money, and our money is guaranteed, or the capital put into that investment is guaranteed protection. The fund, or the money market fund, has 4 layered control or protection, which is offered in segregation of functions to autonomous institutions or entities: the fund manager, the custodian, the trustee, and the regulator himself. Number 4, liquidity. Money market funds, by law and regulation, the fund is invested in high quality short-term investment, which means that it is quick for the fund manager to convert the investment back to money. Another reason for liquidity is that money market funds, the investment are sold or exchanged on a 1-to-1 ratio, meaning that for request on withdrawal, the incoming funds for investment can be substituted for what is being drawn down without destabilizing the fund, and that will still or will go towards flexibility, accessibility. Number 5 is high returns. high return when compared with the current rates of inflation. That means that our invested amounts or cash in the money market fund is protected against loss of its purchasing power. We are guaranteed in the uncertain future we will still be able to get what we were able to get at the moment. In other cases, a money market fund will offer a return that is way higher compared to the current inflation rates. Number 6, daily interest computation. Money market funds, the returns are computed and paid on a daily basis. This becomes in handy as a benefit for emergency response, in that when we are accessing our money from the money market fund, we also access the interest that has been generated and paid so far. In many other investments, whatever interest is generated, if you withdraw the amount invested, you lose the interest or the return that has already been paid out or earned but not paid out. For a money market fund, the amount of return paid out is not lost because of a drawdown. Number 7, tax accounting. That is another very important factor to look at when we are talking about a money market fund in whatever aspect. But in the case of our emergency response, a money market fund, the taxes charged on our returns, that is the withholding tax at 15%, is a final tax, which means that at the end of the financial period, investing period, we are not required to account for that tax by way of filing a return. The fund manager is the one charged with the duty or responsibility to account for the tax. So that one saves us from the hassle of taxation accounting. Number 8 is multiple calculation and reinvestment of interest. Why are we talking about the multiple calculations? This is accounts on frequency of interest calculation, the daily payment of interest. How does that one benefit us? Frequency or daily computation, multiple computation of interest and its payout gives us a compounding effect because the interest is loaded to the investment account, forming part of the investment capital or forming part of our principal investment amount. That is accelerating our investment and further cushioning us against loss of purchasing power or value of our money. Number 9, regulation. Money market funds are registered, the fund manager is registered, and regulated by the Capital Markets Authority. At that point, the safety and protection of our investment or money, capital that we have put in the money market fund is guaranteed, because in the event the fund manager or the investment firm go under or collapse, the funds are safely kept by the custodian, and therefore the regulator or CMA simply appoints another fund manager to continue seamlessly with the investment of the fund. Lastly, but very important, number 10, we access experience, exposure, and expertise from the money market fund. These funds are run by skilled persons through experience, that is repeat business, education, and exposure. And that to us means we get to access their skill in risk mitigation in the investment and market adaptation, as opposed to if we were to manage the fund on our own, which is a huge benefit. So therefore, money market funds, owing to those 10 important practical factors, form a good avenue for management and response to emergencies and accumulation or build-up of emergency funds, because there are happenings in our lives that many times are untimely, and the period between when they happen and when we restore ourselves, the gap in between has to be managed. For example, if one was to lose a job, they will take time before they get another job. If a business was to collapse, it will take time before you establish a new business from which you can survive on. And therefore, an employed person, in order to cushion the gap between one job to the other, is estimated should build up or accumulate an emergency fund of about 3 to 6 months worth of their living expenses. That is their lifestyle expenses. A self-employed person is estimated should accumulate a fund of between 6 to 9 months of their ordinary living expenses. And a business person should accumulate and hold a minimum of 12 months worth of living expenses. And that gives us a valid reason why money market fund is good for emergency response and emergency fund.